Welcome you all to today's meeting. It's going to be a very short one, but I hope it is going to help you. And I must tell you that I'm recording the meeting as well, so that at your free time, you can have a playback of whatever we have done over here. So once the meeting is being recorded, you must know how to say certain things and do the things.
Okay.
As I have communicated for you already, today we'll be looking at accounting for associate undertakings. That will be the focus for tonight. Yesterday, we started looking at some certain things in financial accounting. I mean, some of you were not there, but don't worry, I'll find time for all of you. So whatever we are going to do today, all of you here are going to start afresh. So when we talk of accounting for associates, or we talk of associates undertakings, we already know what is meant by a holding company. We already know what is meant by a subsidiary. We already know what is called a group. And by extension, we know, or we were introduced to significant influence and control. Now, we said control is the power to govern the financial and operating policies of another entity in order to derive economic benefit from its activities. But one can gain control when you acquire more than 50% of the equity shares in another entity. Or in other words, you control an entity if you have 50% or more than 50%, sorry, you have more than 50% of the voting rights in another entity. Now, we said significant influence is the power to participate in the financial and operating policies of another entity, but not to control. And companies with significant influence have less than 50% of the equity, or 50% or less of the equity shares in another entity. So, for example, somebody who have 80% share in another entity is classified as the holding company or the parent company. Somebody who holds 25 or 20% in another entity is classified as the minority. And this minority, they have the significant influence. Now, accounting for associate undertakings takes its mandate or takes its genesis from significant influence. So, what do we mean by an associate? An associate is an entity in which a company holds between 20 to 50% of the equity shares. So let's say we have company A and company B. Company A holds 40% of the equity shares in company B. Company B then becomes an associate of company A. That is what it means. So if you were supposed to calculate the holding percentage or the appropriate percentage holding, and you end up determining that the percentage holding is between 20 and 50%, then you are going to prepare the consolidated books of account using the accounting for associate undertakings method. Now, under accounting for associate undertakings, there are two methods we use in consolidation. We have the consolidation method, and then we have the equity accounting method. But we always prefer the equity accounting method because of the significant influence structure over here. So anytime you are dealing with accounting for associate undertakings, you go by the equity accounting method. You go by the equity accounting method. Now, the standard clarifies that investment in associates over which the investor has significant influence must be accounted for using the equity method, whether or not the investor has invested in subsidiaries and prepared consolidated financial statements. However, the investor does not apply the equity method when presenting separate financial statements prepared in accordance with IAS 27. So that is basically what the standard is saying, that once you have significant influence and you are consolidating your books, then you use the equity accounting method in consolidation. Now, under the equity accounting method of consolidation over here, the intragroup balance eliminations still holds over here, or the methods and principles we follow in eliminating intragroup balances, we follow the same over here. What changes here is the method of presentation. What changes here is the method of presentation. If you have any question, you raise up your hand and I'll call you. Now, how does the equity accounting method work? Under the equity accounting method, the investment in an associate is initially recognized at cost, and the carrying amount is increased or decreased to recognize the investor's share of profit or loss of the investee after the date of acquisition. When we start doing the calculations or we start doing the practicals, you understand the theory better. Now, let me just explain another point for you. Now, we already know how to prepare the consolidated books of accounts, where we do the line-by-line addition of the items in the financial statement. So, for example, you pick the balance sheet of A, you add it to the balance sheet of B, you said you have consolidated the account with the mindset of eliminating intragroup balances. So you are not just adding the accounts to each other, but you are eliminating intragroup balances. Now, when we come to accounting for associate undertakings, we don't add the line item just like the way you know how to do. But what you do is what has been explained under this particular slide over here. You pick your own financial statement, and all you do here, this is what I'm talking about. All you do is to take, let's say, your financial statement, then add the proportion of interest you have in the other company to your financial statement. Case closed. What it means is that if you have declared profits, then you go to your associate account and find out if your associate has also declared profits. Then the proportion of that profit that belongs to you will be added to your profits. If you have declared loss, you also go to the associate account to see if the associate has declared profit or loss. Whatever has been declared at that material time, you also add it to yours, and then you continue. If you are paying tax, you think of your associate. Your associate too must be paying tax, and the proportion of that tax will be attributed to you. So you also find the tax proportion and add it to yours. That is how it is done. That is basically on the phase of consolidating the profit and loss account. When you go to the consolidation of the balance sheet, it also follows a similar procedure. You don't add the asset of A to asset of B, liabilities of A to liabilities of B. No. You pick the asset of A, pick the appropriate investment you made in B and add it to your assets, and then you carry on. That is basically what you do when it comes to the balance sheet. And we'll represent that one in practicals, and then you understand. But I must draw your attention that whenever you are finding or you are determining the value of investment, it is equal to capital plus surplus. So the capital plus surplus is equal to the net assets of the business. So it is based on the net assets of the business that we find our investment proportion for the investing company. Whenever I'm determining my net assets and there is goodwill in the books, then I add my goodwill to rates before I determine my investment. Take note, whenever I'm determining my net assets and there is goodwill in the books, then I have to add the goodwill to it before I find the net assets. If I don't have goodwill, then I proceed with just adding my capital and surplus. As I'm saying, if you have any question, raise up your hand and then ask. There is an illustration over here, and I want us to look at this particular illustration. So you have your handout, you locate that particular illustration in your handout. If you don't have it, it is going to be here for you whilst I walk you through the solutions. So you pick your handout, your jotter, your pen, your calculator, and then we start. Now you have the question that reads, the balance sheet of Predator and Victim as at 31st December 2013 is as follows. So you have the balance sheet over there. Tangible fixed assets, investment in Victim, dividend receivable, dividend payable, other current assets, other current liabilities. You have stated capital, then you have surplus. Then the additional information reads, 6 million shares were acquired on 31st December 2012. 6 million shares were acquired on 31st December 2012. When Victim surplus were 1 million and the net asset of Victim as at 31st December 2012 were 30 million, full stop. So there should be a full stop over there. The net assets of victim as at 31st December 2012 were 13 million. Then we'll make some small adjustments to the question over here. Goodwill on consolidation is fully written off. Goodwill on consolidation is fully written off. I'm emphasizing it again. Goodwill on consolidation is fully written off. Then the question says that we should assume the equity accounting method for the investment in victim. That's for the balance sheet. Then you have the profit and loss over there. You have the turnover, operating costs, on and on and on, to profit after tax. Then from there, you have income surplus account also given to you. So take note that whenever you see consolidated profit and loss account, or you see a profit and loss account, there is going to be an income surplus attached to it. So these are all the informations we have been given over here. And we have to consolidate this particular account. Now, before we start, the question made mention of goodwill, but we don't know the amount of goodwill that we have. The question talks of goodwill, but we don't know the amount of goodwill that we have. So we have to find our goodwill. We have to find our goodwill. Pearl. What did we do in the accounting yesterday? I can hardly hear you. Hello, Pearl, can you hear me?
Consolidated. And then example 2 in profit.
Yesterday we did consolidated profit and loss, right?
Yes.
Okay, that's fine. All right. I just wanted to confirm. Okay, so let's carry on. So this question made mention of goodwill.
Yes, please.
But here is the case, you don't know the goodwill. So you find the goodwill. So open your cost of control account quickly. Hello? Open your cost of control account. Have you done that? Now, at the debit side, we're told that investment in victim, look at the balance sheet, investment in victim is 7,200. So at the debit side, you have to have 7,200 as the investment in your cost of control. You do that. Then we are being told that the net assets at the date of acquisition is 30 million. But this guy acquired 6 million shares in victim. We don't know how many shares is victim having. When you look on the balance sheet, victim stated capital is 12,000. And they are telling us that for every one share, it is 1 cedi. So we can assume that victim is having 12,000 shares. So if Predator bought 6 million shares of the 12,000 shares, then to know the percentage holding, you divide the 6 million by the 12,000 shares, multiply by 100, and you are going to get 50%. So we can confidently say that victim is an associate of Predator because Predator holds 50% in victim. Now, when you look at the footnote, they said net assets is 30 million. So you do 50% of the 13 million or 13,000, and that will give you the net assets at the credit side of the cost of control. So when you do that, how much are you getting? 6,500. Okay. So
yes,
you balance of the account. Somebody can say that he is not going to take that particular 13,000 they are talking about or whatever. What that person will do is that no, let's leave it over there. Let's go by that. So you get 6,500. So the difference between 6,500 and 7,200 is how much?
Yeah, please, it's 700.
It's 700. So that is your goodwill. So goodwill is 700. Good. Then you open another account. Now, let me tell you something. Anytime you are going to consolidate profit and loss, there are two accounts you must always open. The opening income surplus accounts and then the closing income surplus account. So always, I prefer you opening the income surplus account for the opening before preparing the consolidated profit and loss account. So open another account and name it the opening income surplus account. Now,
the opening income.
if your video is on, you can off your video so that you can have enough bandwidth. Yes, let's hear you.
Sir, I was saying that the opening income account, is it after the cost?
Yes, it's going to come just after your cost of control.
Okay.
So in your opening income surplus account, you are going to have balance brought forward. The rest, can you hear me? It looks as if it's only Pearl
Yeah, we can hear you.
that is talking. Okay. Opening income surplus account. Predators account is 10,900. So at the credit side, you have balance brought forward 10,900.
Okay.
Put it there. Then you have post-acquisition surplus. Now, we're being told that on the date of acquisition, victim surplus were 1 million. Have you seen it in the footnotes? 6 million shares were acquired on 31st December 2012 when victim surplus were 1 million. So that is the surplus that was there on the date of acquisition. So to know the surplus as at the date of opening, when you go to victim's account, victim has declared a profit at the beginning of the year 2,300. But on the date of acquisition, the surplus that was there actually is 1 million. So you do 2,300 minus the 1,000, whatever you have, you strike 50% on it and tell me how much you are getting. And that one to go to the credit side of your opening income surplus account.
Yeah, come again.
I'm saying that at the opening income surplus account, you are going to have a balance brought forward of 10,900 at the credit side.
Okay.
The same credit side, you are going to have surplus. And the surplus, you calculate it like this, 2,300 minus 1,000 multiplied by the 50%. And this 2,300 is the opening surplus of victim minus the pre-acquisition surplus of victim, 1,000.
Okay.
So basically 1,300 multiplied by 50%. How much are you getting? $650. Okay. Then at the debit side of that particular account, we said goodwill on consolidation is fully written off. So it debits that particular account. Goodwill. And the goodwill you had is 700. So it debits that account is 700 and you balance off the account. So how much are you getting?
The debit side will only be goodwill 700.
Yeah, you are debiting that account in goodwill 700. How much is the balance of the account?
1,850.
1,850 or 10,850, right?
Yes.
Okay, that's fine. Now, from there, you open the next account, consolidated profit and loss account. Consolidated profits and loss account. Then you start turnover. You put down 9,000, that of only pre-data. Here we don't add the two.
At the debit side of credit.
Hey, profit and loss account. You don't know how they open profit and loss accounts. So you put it down, turnover 9,000. Less operating cost 4,500. You get operating profit 4,500. So consolidated profit and loss account, you have turnover 9,000, operating cost 4,500, operating profit 4,500. Then just under the operating profit, you write share of associate profits. Share of associates profits. Then you go to the associate account, which is victim. You pick the profit declared. As at that time, you are also declaring your operating profits. And the profit declared is 2,250 on victim's account. So you strike 50% because you are having 50% in victim. You strike 50% on the 2,250, and that is what you write there as share of associate profits. How much are you getting?
$1,150.
1,150, that's fine. So now you add it to your 4,500, then you get another total.
think it's 1125.
Okay. Then you can see investment income 400 over there. Victim is also declaring proposed dividend. Go to victim's account, the second to last thing on the victim's account. Victim declared proposed dividend 800. Now we already know that Predator is having 50% in victim. So whatever profits or whatever dividend victim declares, 50% belongs to Predator. So if victim declared dividend of 800, then 50% of that 800 is going to Predator. And 50% of 800 is 400. And so therefore we can confidently say that that 400 investment income we are seeing on Predator's account is actually coming from victim. And to that large extent, it is going to constitute what you call intragroup balance. So once it is part of intragroup balance, we have to eliminate it on the face of the account. And so therefore, this 400 will not appear again. Now, secondly, we continue.
So should we write investment income 400?
No, don't write it.
Okay.
It is part of intragroup balance, so it will not come. So that total you have there is what you call profits before tax. The total you had after adding the 4,500 to the 1125 or 11 something is now called your profit before tax.
Okay.
Then you bring your tax of 1,300. In case the meeting has disconnected, kindly reconnect back because we are using the free version of the Zoom.
Okay.
You write tax 1,300. Then the same principle you followed when you were dealing with share of associate profit, you also write there share of associate tax. Share of associate tax. So as I was saying, you get profit before tax, then you bring your tax of 1,300, then just under tax of 1,300, you write share of associate tax. Then you pick the associate tax of 750, you strike 50% on the 750, then you add it to your tax of 1,300. So 50% on 750, how much are you getting?
$375.
375. So you add the 375 to the 1,300 and less it from the profit before tax.
$3,950.
How much? You say I get how much?
3,950.
3,950. Okay. We will take it like that. I will presume that is the right answer. Okay. So from there,
So please, what's the name of the 3,950?
that's the profit after tax.
Okay.
Then from there, you prepare the closing income surplus account. I told you prepare two different accounts when it comes to consolidated balance sheet. So we have consolidated profit and loss, sorry. We have prepared our opening income surplus account. We have prepared our consolidated profit and loss account. We are going to prepare our closing income surplus account. So you have the last account, the income surplus account. Then you write balance brought forward. Then you pick the opening income surplus account balance you had. The opening income surplus account balance you had, you said it is 10,8 something.
10850.
10,850, super. So that's the balance brought forward that will come to this particular account.
Hello.
Then
Hello.
from here, you add the profit for the year. You say add profit for the year. And the profit for the year, you have calculated it as 39,650.
Yeah.
So you add it to it.
You add it to the opening balance.
Yes. To the opening balance, 10,8 something you had. What will be the total?
One 14800.
One what?
14800.
Okay. Then you less proposed dividend. So you go to predators account. Then you pick predators proposed dividend and subtract from it.
So the 14800 is what?
You saw what?
I think that the 14800 is our.
Okay, so when you add 10,850 plus 3950 and subtract the 2,000 proposed dividend by predator, you get how much?
Get 12,800.
12,800. So that is how your income surplus account will look like.
I was saying that when you add the opening balance and you add the profit for the year and you get 14,800, what is the name of for the 14,800? Otherwise, you know that or something. Although you know the Google system. You have me. How? You do the program. So some are really because and they have competition couple. Like maybe volleyball
Yeah.
from football now, maybe from
Are you here with me? Are we there?
Yes, yes.
Okay. So just a quick recap. Somebody said she's lost more.
From the share of associates profit,
So
lost from that.
I said in an attempt to prepare the consolidated profit and loss account, you are just maintaining the account of predator. Unlike what you do at first, that you add victims own to predator, like when you say turnover, then you add 9,000 plus 4,500. Then you add 45 plus 2,250 in that order. We are not doing it here like that again. Here, when you say turnover, you pick that of predator 9,000, then you put it down. You pick his cost of sales 45, then subtract from it, then you get another 45 as operating profits. Now, when you do that, you get profits 45. By then, victim 2 might have declared profit of 2,250. So you say, okay, once I declare profit, victim 2 should be declaring profit by now. Let me go and look at his profit he has declared and then take my portion. So at that point, you go to victim's account. Victim has declared a profit of 2,250. So he said, okay, you have 50% in victim. So victim, my 50%, Maji. Then you strike 50% on the 2,250. And that is what you call the share of associate profits. Then you add it to your 4,500. When you do that, you get what you call profit before tax. So after profit before tax, what do? You look out for the tax proportion you are going to pay or the tax component you are going to pay. In your account, you are going to pay 1,300. So the moment you are going to pay tax, victim 2 would have reached a stage where he or she will also pay tax. You go and look for victim's tax. Victim is supposed to pay 750,000 tax. So 50% of that is yours. So you also strike 50% on the 750, which somebody said it is 375. So that one you also call it share of associate tax. So you now come and add the 375 to the 1,300, which will give you 1,675. Then you subtract it from your profit before tax. And then the answer you get now is what you call the profit after tax. Then we said after that, you prepare your income surplus account, where you pick the balance you had in the opening income surplus account. You add the profit for the year. Somebody said it is 3,950 or so. So you add the 3,950 to the 10,850, you get a total. Then you subtract the proposed dividend of predator, which I'm seeing here to be 2,000 from it. Then they said that answer to is 12,800 or so. So the balance you should be having on your closing income surplus account is 12,800. Emma, are you okay now? Okay. So from here, you prepare your consolidated balance sheets. You prepare your consolidated balance sheet. So you write there, consolidated balance sheet as at 31st December 2013. Consolidated balance sheet as at 31st December 2013. Then right there, tangible fixed assets, 16,500. Then you write
Hello.
investment in victim. But this time around,
Hello, sir. Can you hear
yes,
you? Consolidated balance sheet.
consolidated balance sheet. Then under the balance sheet, you have tangible fixed assets, 16,500.
This time you add the two.
I am still emphasizing under accounting for associates, you don't add the two.
Okay.
Then write investment in victim. I was explaining how to calculate for the investment here. That to find the investment, you add the capital of victim and surplus of victim. Now, when you go to the question, capital of victim is 12,000. Surplus
Yes.
of victim is 3,000. So 12,000 plus 3,000 is 15,000. And
Yes.
in this 15,000, Predator is holding 50%. So you strike 50% of this 15,000. You will get 7,500. And that is what you write under the investment as the investment in victim, 7,500 and not 7,200 anymore. So that is how we find the investment when we come to the balance sheet under accounting for associates. You add the capital and surplus, then you strike the appropriate percentage on it.
Okay, sir.
Then you continue. Current assets. So under current assets, you have dividend receivable, 400. Then you also have other current assets, 14,400. Dividend receivable, 400. Other current assets, 14,400.
Okay.
Then you total, which you will definitely get 14,800. Then you less your liabilities. I can see other current liabilities, 4,000 over there. I can see dividend payable, 2,000. So your liabilities here is going to be only 6,000. Your liabilities here is going to be only 6,000.
And other current liabilities.
So less your 6,000 from the 14,800. How much are you getting? Yes.
I can see other current liabilities to be 4,000.
Yeah, I said other under current liabilities, you have other current liabilities, 4,000. And dividend payable, 2,000, making 6,000.
Okay.
So you are subtracting the 6,000 from your, is it 14,800 current assets? How much are you getting?
8,800.
8,800. Then you add it to your tangible fixed asset and then the investment to get one side of your balance sheet to balance.
So you get 32,800.
32,800. That's fine. Then go to finance by.
Okay.
Finance by stated capital. So you pick that of predators own alone, and it is 20,000.
Okay.
Then you add your surplus. The surplus of 12,800 that you had from the closing surplus account. To balance up the second side of the
12,800.
okay. So 12,800 plus the 20,000 should give you the 32,800. So once you have done that, you have successfully balanced the account, and that is the solution or the requirements for the question.
Yes, sir.
Any question? We don't intend to waste much time, so I'll leave you to sleep so that tomorrow to meet, then we'll also do something small. I heard tomorrow you guys are writing mid-sem.
Yes.
Which one are you writing tomorrow?
Accounting.
Financial accounting.
Yeah.
And what else?
We only have accounting now.
Then accounting theory.
No, only accounting.
Only financial accounting tomorrow.
Yes, yes.
Oh, okay. 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 All right, that's fine. Then it's good we did accounting for associate tonight. Okay.
Yes, yes.
So I think I have some question here in my book. I'll snap it for you to see if you will be able to try your hands on. Okay.
Okay. Is it under associate?
Let me see. No, it's not under associates. But I'll still snap it for you to see.
Okay, sir.
So we'll meet tomorrow in class.
Okay.
Okay.
Thank you very much.
All right.
Thank you, sir.
Okay.